Preparing for a Fannie Mae Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What do you know about Fannie Mae and its role in the housing finance system? Fannie Mae is a government-sponsored enterprise that supports liquidity and stability in the U.S. housing market. It purchases qualifying mortgages from lenders, finances them through debt and mortgage-backed securities, and helps lenders continue making new loans. Fannie Mae generally does not originate mortgages directly. Its activities connect borrowers, lenders, investors, and the broader capital markets. I would also mention that it has operated under federal conservatorship since 2008, which shapes its regulatory and capital framework. While answering, focus on Fannie Mae's mission, secondary mortgage market role, liquidity support, conventional mortgage financing, relationship with lenders, and distinction between purchasing loans and originating mortgages. Question 2. Why do you want to work at Fannie Mae? I want to work at Fannie Mae because it combines sophisticated finance with a direct societal purpose, expanding access to sustainable homeownership and rental housing. The analyst role would let me apply financial analysis, data skills, and disciplined problem-solving to credit, capital markets, or operational decisions. I am especially attracted to the scale of the institution, where small analytical improvements can affect thousands of loans and investors. That combination of mission, complexity, and measurable impact is compelling. Make sure to cover the organization's housing mission, analytical complexity, public impact, interest in financial markets or risk, relevant skills, and a specific reason the analyst role matches your career goals. Question 3. How does Fannie Mae make money? Fannie Mae primarily earns revenue through guarantee fees charged for assuming credit risk on mortgage-backed securities, along with net interest income from retained assets and other investments. It may also earn fees related to securitization and servicing activities. Against that revenue, it absorbs credit losses, funding costs, administrative expenses, and other risks. Therefore, profitability depends not merely on mortgage volume, but on appropriate pricing, underwriting quality, interest rate management, and efficient operations. In your answer, talk about guarantee fees, net interest income, mortgage portfolio economics, securitization activities, credit risk transfer, operating expenses, and why profitability depends on both volume and risk-adjusted pricing. Question 4. Explain the difference between the primary and secondary mortgage markets. The primary mortgage market is where borrowers obtain loans from banks, mortgage companies, or other lenders. The secondary market is where those loans are sold, pooled, financed, or securitized after origination. Fannie Mae operates primarily in the secondary market by purchasing eligible loans or guaranteeing securities backed by them. That activity gives lenders liquidity, allowing them to recycle capital into new mortgages rather than holding every loan until maturity. Be sure to mention borrowers and lenders in the primary market, loan purchases and securitization in the secondary market, liquidity benefits, risk transfer, and how Fannie Mae connects the two markets. Question 5. What is a mortgage-backed security, and how does Fannie Mae use it? A mortgage-backed security represents an interest in a pool of mortgage loans, with investors generally receiving principal and interest cash flows from borrowers. Fannie Mae can purchase eligible mortgages, pool them, and issue or guarantee securities backed by those loans. Its guarantee supports timely payment of principal and interest, making the securities attractive to investors. The resulting securitization transfers funding into capital markets and helps maintain mortgage liquidity for lenders and borrowers. Focus on mortgage loan pooling, pass-through cash flows, principal and interest payments, securitization, guarantee obligations, investor demand, and the distinction between agency and non-agency mortgage-backed securities. Question 6. What factors determine mortgage credit risk? Mortgage credit risk reflects the probability and severity of borrower default. I would examine credit score, loan-to-value ratio, debt-to-income ratio, reserves, occupancy, property type, documentation quality, and geographic concentration. Macroeconomic variables such as unemployment, home prices, and interest rates also matter. A strong analysis separates borrower-level risk from portfolio-level concentration risk, then considers credit enhancements, servicing quality, and expected recovery values if a loan becomes delinquent. While answering, cover borrower credit score, loan-to-value ratio, debt-to-income ratio, property type, geographic concentration, documentation, economic conditions, delinquency behavior, and the importance of combining borrower and portfolio-level analysis. Question 7. How would rising interest rates affect Fannie Mae? Rising rates typically reduce refinancing activity and new mortgage demand, while increasing funding costs and potentially lowering the fair value of fixed-rate mortgage assets. Prepayments may slow, extending asset duration and creating extension risk. The ultimate earnings impact depends on hedging, the asset-liability mix, guarantee fee income, and credit conditions. I would analyze both accounting effects and economic exposure, because reported fair value changes can differ from long-term cash flow performance. In your answer, discuss mortgage demand, refinancing, asset and liability duration, prepayments, funding costs, fair values, net interest income, and the difference between short-term earnings effects and long-term portfolio risk. Question 8. What happens to mortgage prepayments when interest rates decline? When rates decline, borrowers have a stronger incentive to refinance, so mortgage prepayments usually accelerate. Investors receive principal sooner than expected and must reinvest at lower yields. For mortgage-backed securities, faster prepayments shorten duration and can limit price appreciation compared with ordinary bonds. For Fannie Mae, the effect depends on the portfolio and hedges. Lower rates may support origination activity, but faster prepayments can reduce expected interest income and change asset values. Make sure to cover refinancing incentives, prepayment speed, mortgage duration, reinvestment risk, mortgage-backed security valuation, servicing effects, and why declining rates can create both benefits and risks for Fannie Mae. Question 9. How would you evaluate whether a mortgage portfolio is performing well? I would evaluate the portfolio using both risk and return measures. Key metrics include delinquency transitions, defaults, loss severity, prepayment speeds, net interest income, guarantee fee revenue, operating costs, and capital consumption. I would compare actual results with forecasts, prior periods, and relevant benchmarks, then segment the analysis by product, geography, vintage, and borrower quality. A portfolio is performing well only if earnings are attractive after considering expected losses, volatility, and required capital. Be sure to mention delinquency and default trends, loss severity, prepayments, credit characteristics, yield, expenses, capital usage, forecast comparisons, peer or benchmark analysis, and separating volume growth from genuine risk-adjusted performance. Question 10. What is the allowance for credit losses, and how would you analyze it? The allowance for credit losses represents management's estimate of expected credit losses over the relevant asset life. I would review portfolio segmentation, historical loss experience, current delinquency trends, home price and unemployment forecasts, model assumptions, and qualitative overlays. I would also reconcile beginning allowance, provision expense, charge-offs, recoveries, and ending balance. The key question is whether the estimate reflects updated information without being mechanically driven by a single model or overly optimistic forecast. Focus on expected lifetime losses, current conditions, reasonable forecasts, historical experience, portfolio segmentation, qualitative adjustments, model risk, and reconciliation between provision expense, charge-offs, and ending allowance. Question 11. How would you build a monthly financial analysis for a Fannie Mae business unit? I would begin by validating source data, definitions, period cutoffs, and reconciliations to the general ledger or approved reporting system. Then I would compare actual results with budget, forecast, and prior periods, decomposing variances into volume, pricing, mix, timing, and expense drivers. I would investigate unusual movements with business partners, document assumptions, and distinguish recurring from one-time items. Finally, I would present the key risks, conclusions, and recommended actions clearly to decision-makers. In your answer, describe data validation, actual versus budget analysis, key driver decomposition, trend review, variance investigation, stakeholder discussions, documented assumptions, and concise communication of risks and actions. Question 12. Tell me about a time you found an error in financial or operational data. In a prior analysis, I noticed that a monthly expense variance did not reconcile with the supporting transaction file. I traced the issue to a duplicate import created when two reporting periods overlapped. I compared records by date, vendor, and amount, confirmed the finding with the system owner, corrected the report, and documented a control to flag duplicate identifiers. The result was a cleaner submission and a repeatable validation step that reduced the risk of recurrence. While answering, use a clear situation task-action-result structure, quantify the issue if possible, explain validation steps, describe communication and correction, and emphasize root cause prevention rather than simply identifying a mistake. Question 13. What Excel tools would you use to analyze mortgage or financial data? I would use pivot tables to summarize loans by product, vintage, geography, or delinquency status, and SUMIFS or XLOOKUP to connect supporting data. I would use logical checks to identify missing values, duplicates, and unexpected classifications, then create charts showing trends and concentration. For forecasting, I might build driver-based scenarios with clearly separated assumptions. I also document formulas, protect key cells, and reconcile totals so another analyst can review the work efficiently. Mention pivot tables, XLOOKUP or index match, SUMIFS, logical formulas, error checks, conditional formatting, charts, scenario analysis, data validation, and careful documentation of assumptions and outputs. Question 14. How would you assess the impact of a rise in mortgage delinquencies? I would first determine whether the increase is broad-based or concentrated in specific vintages, products, geographies, or borrower segments. Next, I would analyze roll rates, cure rates, defaults, severity, foreclosure timelines, and projected recoveries. I would estimate effects on credit loss provisions, capital, guarantee economics, servicing costs, and cash flows. Finally, I would test adverse scenarios involving unemployment or declining home prices and identify actions such as servicing interventions or tighter risk controls. Be sure to cover cohort and product segmentation, transition rates, expected defaults, loss severity, provisions, capital, servicing effects, macroeconomic drivers, stress scenarios, and management actions to mitigate further deterioration. Question 15. What is counterparty risk, and why is it important to Fannie Mae? Counterparty risk is the possibility that a party supporting Fannie Mae's transactions cannot meet its contractual obligations. Relevant counterparties include lenders, mortgage servicers, insurers, derivative dealers, and custodians. I would assess each party's financial strength, exposure, collateral, contractual protections, concentration, and recovery prospects. Monitoring matters because a counterparty failure can disrupt cash flows, servicing, or hedges even when the underlying mortgages remain sound. Strong controls therefore combine due diligence, limits, collateral, and contingency planning. Focus on exposure to lenders, servicers, insurers, derivatives counterparties, and custodians, default consequences, collateral and eligibility requirements, monitoring, concentration limits, and the need to distinguish probability of default from exposure and recovery. Question 16. How do accounting and economic value differ for mortgage assets? Accounting value is determined under applicable reporting rules, while economic value reflects the present value of expected future cash flows and risks. For mortgage assets, those cash flows depend on rates, prepayments, defaults, recoveries, and servicing behavior. An asset may show an accounting loss from market movements even when expected credit losses remain limited, or vice versa. I would therefore analyze reported balances alongside duration, stress results, hedges, and expected cash flows before drawing conclusions. In your answer, distinguish financial statement measurement from underlying expected cash flows, explain fair value and amortized cost, discuss assumptions such as rates and prepayments, and note why analysts should reconcile reported results with economic exposure. Question 17. How would you prioritize competing requests from senior stakeholders? I would rank requests by regulatory or reporting deadlines, business impact, risk, dependencies, and effort required. I would clarify the desired output and decision date for each stakeholder, then create a realistic sequence and communicate trade-offs early. If two priorities genuinely conflict, I would escalate with options rather than silently missing one. Throughout, I would preserve key validation and review steps, because a fast but inaccurate analysis can create greater downstream cost. Make sure to cover urgency, business impact, regulatory or reporting deadlines, dependencies, effort required, transparent communication, escalation of conflicts, and maintaining accuracy rather than sacrificing control quality under pressure. Question 18. Describe a time you worked with a difficult or cross-functional team. On a cross-functional project, operations and finance disagreed about which data definition should drive a performance metric. I scheduled a short working session, documented both interpretations, traced each definition to its source system, and tested the effect on historical results. We agreed on a primary definition and a clearly labeled supplemental view. The project met its deadline, and the documented methodology reduced future debate. I learned that alignment improves when disagreement is converted into testable assumptions. Use a specific example, explain the competing perspectives, demonstrate listening and fact-based communication, describe how responsibilities were clarified, and conclude with the measurable result or relationship improvement. Question 19. What questions would you ask before accepting a data-driven recommendation? I would ask where the data came from, whether definitions remained consistent, and whether the period and population are appropriate for the decision. I would test completeness, outliers, duplicates, and reconciliation to an independent source. Then I would examine methodology, assumptions, sensitivity to key drivers, and relevant benchmarks. Finally, I would ask what limitations or alternative explanations exist. A recommendation is credible when its conclusion remains useful after those challenges, not merely when the spreadsheet looks precise. Focus on source reliability, definitions, completeness, time period, outliers, methodology, assumptions, sensitivity, benchmark selection, limitations, and whether the recommendation supports a decision after considering risks and alternatives. Question 20. Where do you see the greatest risks and opportunities for Fannie Mae over the next few years? I see major risks in housing affordability, elevated rates, potential credit deterioration, climate-related property losses, cyber threats, and changing regulatory expectations. Fannie Mae also faces concentration and liquidity considerations across single-family and multifamily markets. Opportunities include better use of data for underwriting and servicing, responsible expansion of credit access, stronger risk transfer tools, and technology that lowers costs. The priority should be sustainable growth, improving housing outcomes while pricing risk accurately and protecting taxpayers and investors. In your answer, discuss housing affordability, credit deterioration, interest rate volatility, climate and catastrophe exposure, technology and cyber risk, regulatory expectations, multifamily demand, and opportunities to improve access while protecting sustainability. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.